Most drivers notice gas prices ticking up a few cents and groan. But if you listen closely to major global financial institutions right now, you hear a very different reaction. They are sounding the alarm on a catastrophic global recession. To understand why they are panicking, you have to look at where we started. Just a few months ago, the broad consensus was that the US economy had achieved a soft landing. Inflation was supposedly cooling down, and the Federal Reserve was gearing up to cut interest rates. Then, geopolitical tensions in the Middle East escalated. The price of dated Brent oil, the actual physical crude required for immediate delivery from the North Sea, went completely vertical. The global supply of oil actively in transit is now plummeting towards zero. With physical crude becoming harder to get a hold of, regions are struggling to secure deliveries, leaving gas stations completely out of fuel. BlackRock CEO Larry Fink clearly sees the math here. He warns that if supply chain disruptions keep oil hovering near $150 a barrel, the resulting shockwave will trigger a severe global recession. An energy shortage terrifies financial markets for a very simple reason. It mathematically guarantees future inflation. When fuel costs rise, the cost to move every single physical product on Earth rises right along with it. This chart shows the bond market entering panic mode. The 10-year Treasury yield has surged from 4% past the 4.31% threshold, a flashing red alert. Foreign central banks are dumping their U.S. debt, selling off $82 billion in treasuries in just 5 weeks. They are taking capital out of U.S. dollar assets entirely. Instead, foreign institutions are seeking a traditional safe haven, stockpiling physical gold at incredible rates. The U.S. government relies entirely on those foreign buyers to fund its $39 trillion debt. With foreign capital fleeing, recent Treasury auctions for 2-year and 5-year bonds are facing extremely weak demand. The government is rapidly losing its financial lifeline. The scale of this problem is massive. The government is currently paying $1.2 trillion a year simply to cover the interest on its existing debt. That single expense instantly consumes roughly 20% of all U.S. tax revenue. Because investors are fleeing and bond yields are rising, the government is caught in a trap. They have a massive wall of old debt coming due, and refinancing it at these new, higher rates is becoming catastrophically expensive. To keep the government funded, the Federal Reserve is executing a drastic pivot. They are abandoning quantitative tightening and returning to printing money. Over roughly 90 days, the Fed generated $117 billion out of thin air. They deployed this fresh capital specifically to buy up the short-term U.S. Treasury bills that foreign investors refused to touch. Generating new currency to buy your own debt carries a fatal side effect. It actively devalues the dollars already circulating in the economy, which fuels even higher inflation. This cyclical diagram shows the exact trap we are caught in. An energy shock drives up costs, forcing expensive debt refinancing, which requires money printing, which drives costs up further. This loop mathematically guarantees a secondary inflation wave, with projections pointing toward 5.2%. This equation outlines the ultimate economic nightmare. High inflation combined with stalled economic growth equals stagflation. The macro crisis is crushing the micro consumer. Mortgage rates, which had briefly dropped below 6%, have suddenly surged back to 6.46%, effectively destroying housing affordability for new buyers. Corporations are shielding themselves by passing their costs down the line. Amazon recently implemented a 3.5% fuel and logistics surcharge on its sellers, ensuring that everyday essentials are going to get more expensive for the end consumer. Goldman Sachs economists are looking at this data and downgrading their overall U.S. GDP estimates. They now project the ongoing loss of 10,000 payroll jobs every single month. The chain reaction is complete. A geopolitical crisis that restricted oil tankers on the other side of the planet has mutated into unavoidable systemic financial pain for everyday American businesses and citizens. JP Morgan CEO Jaime Dimon warns that the entire global economy is currently resting on 2 colliding tectonic plates, both of which are ready to fracture. The first tectonic plate is the U.S. government's fiscal addiction. Borrowing an additional $2 trillion every year creates an entirely unsustainable foundation. The second tectonic plate is a highly volatile global political landscape. The U.S. relies on foreign adversaries for critical adversaries of its own security. leaving vital supply chains exposed to sudden disruption. Historically, we have seen exactly what happens when energy shocks collide with rampant inflation. The 1970s delivered a brutal era of stagflation, defined by endless gas lines and a paralyzed economy. This energy shock is a targeted strike on a highly vulnerable financial system. Between failing Treasury auctions, a massive debt burden, and a desperate return to money printing, the structural rot of the U.S. economy is fully exposed, threatening a historic depression if the course is not corrected.